Muy bien, la última conferencia de la tarde estará a cargo del doctor Joseph NELESEN, director general de estrategias de Smart Beta para clientes institucionales y de América Latina de BlackRock. Hablará sobre el Factor Investing, una forma diferente de analizar los portafolios. Doctor NELESEN tiene la palabra y bienvenido.
Thank you. And again, I'll apologize for not doing this in Spanish, and also for, well, I want to apologize for talking about Smart Beta. I have a little more to say, but I confess that a lot of the slides that I had were covered really well by Craig, Guillermo, and Raman. So we'll do a little more Smart Beta, but we're going to talk about some other developments too. And it seems to be sports as a theme today, and I could talk about Juberhen Martinez, who's going to fight for the gold medal. Diego, my colleague, just informed me. We could talk about Oscar Figueroa, who won the first gold. That's exciting. But I'm a cycling fan. This is a sport that I've loved for a long time. And I don't know if you can see any of the characters on the screen. Only 2 out of the 3 pictures are Colombians, if you can't see the picture. This is Tour de France riders on the far left. They're back in the 1920s. They're enjoying a cigarette during the race. This guy's kindly lighting the smoke for his buddy. But they're competing in the Tour de France, which still goes on today. And then in the 80s, you have Luis Herrera, who was one of my early heroes. I really liked the way the Colombian teams came and challenged the Europeans. They weren't really welcome there, right, at first, but he really stood out. And of course, Quintana today, so he's a really exciting rider for me. But the point of bringing this up is not just because I have nothing left to say since Smart Beta was already talked about, but because there's actually a message here. When you think about through time, right, these are all human beings, the same physiology, the same characteristics that they've had over time. But what has changed? How have the speeds become quicker in the race? Things have changed because of technology, of physiology, of science. There's more to know about nutrition, more about how to train, how to perhaps sleep at altitude to get more oxygen, flexibility, technology in the bicycle. Over time, things that are the same also change through just becoming more advanced through science. And this happens in investing too. You saw Guillermo had this very same slide, and this is a very popular slide for talking about Smart Beta, because it really shows how over time the total return in investments is becoming more and more explainable by indexes, by factors. The thing that you should know about Smart Beta is not only that none of us really like the term Smart Beta. Journalists like it because it sounds like it's something new, and it really isn't. But Smart Beta is really about taking these concepts of factors and applying them into indexes. Institutions around the world are taking advantage of factors. We've spent the whole week here in Colombia. We've been here many times talking with people who are using factors right now in their portfolios. And they're thinking more and more about how to expand, and I'll show you some of the ways they're thinking about this today. But you used to seek out the managers with the highest return, and then later, of course, alpha and beta were separated through the use of CAPM, beta being the market, alpha being what more can that manager give you. And of course, more factors like value, quality, momentum, small cap, minimum volatility, these explain more of that performance. So what's left is that alpha that you heard Craig talk about more and more is hard to achieve. In general, let's talk about what a factor is. You've heard a few definitions. The way we think about it is a characteristic that explains the risk and return features of a security, of an equity usually, although fixed income can have factors too. So factors have been with us for a very long time. I don't know if anybody recognizes what's happening on the picture on the left. This is a gentleman back in the early days looking at a ticker tape, right? This is what you would see on Bloomberg today, the prices of the stock live coming through the market. And he's watching very closely what's happening. And he might be doing one of 2 things. He might be looking at the price of a stock relative to that same stock yesterday or last week or last year. Or he might be looking at the price of that stock compared to other stocks in the market, right? Either way, what he's doing is really exhibiting a factor we call momentum investing. He's looking for the price changes, and he's not really examining other features of the company. Now, another old factor we could show would be something called value. And everybody knows value investing. I think it's about finding an asset that is priced lower than in what it is really worth. So if you looked at that same gentleman in a different way, he might be looking at financial statements, balance sheets, annual reports, and figuring out all of the characteristics of a company, the debt that it has, the earnings. There's a book that goes far back as 1934 called Security Analysis that talks about this kind of investing. And even momentum investing, there was a book in 1923 called Reminiscences of a Stock Operator. And I haven't read it, I confess, but I know that it covers a lot of these momentum strategies before we really knew what to call them. But these are both two factors that are broad and persistent drivers of return. And what do those two words mean? Broad means it will work in a lot of different asset classes and within each asset class. So you can think about value in equities, which is common. You could also think about it in real estate, fixed income, commodities, a lot of places. And persistent means that effect of lowering risk or increasing return lasts over a long time. It can be explained. There was a paper recently from a researcher whose name I forget, but he's at the University of Michigan, who identified 600 factors. And when you can come up with 600 factors, this is why journalists and some investors start to say, maybe this is a trend, maybe this is a fad that will go away. But realistically, there really are only maybe 5 or 6 that truly matter over the long term. And we'll talk about those today. On the right, you see a guy with a lot of screens. That's too many screens. I don't know. It's just an example of, the change in technology, the amount of data that we have to harness today. I've seen people with 4 screens in my office. I think they're showing off. They can't look at that many. But I assure you, you really only need one computer screen or somebody you know with a computer screen to use factor investing. It's not that complicated. So how are we using this one computer screen you might have, right? Or how are we talking about factors? Again, you heard some of the earlier speakers like Craig talk about how hard it is for active managers to generate alpha. It's getting tougher and tougher, especially in the low yield environment. And it may be hard to see this screen, but one of the things we've been doing and other asset managers have been doing is helping investors understand the sources of return. So if you look in this kind of attribution, this green box shows the total return for a fund, for an active manager. And then it starts to break into pieces. How much of that is the benchmark and how much of that is beating the benchmark? If that is positive, you can break it down further. How much is coming from factors? Value, size, momentum, quality, low volatility. And how much return is coming from that manager's skill to pick stocks? The truth is, in more cases than not, this is negative. This includes the fees, it includes the stock picks, and it's a very hard job. I'm not saying anyone could do it easily, but more and more factors are explaining the return. So the question becomes about what an investor should pay in fees and risk for that kind of performance. And technology like this is more and more available to all kinds of investors. Small ones, large ones, but it's something that's certainly changing the industry and it's changing the way indexes are being used. And we've taken some time, you saw also S&P or FTSE Russell did this as well. We've taken some time to ask questions about how institutional investors are using smart beta or factors. So we did a study with The Economist magazine in early 2016 of asset managers around the world, more than 200 of them, with assets ranging from $1 billion to more than $25 billion, and found that almost 9 out of 10 of them were using factors in some way in their overall investment process, either for risk reduction or higher return, or both. And this is global. I mean, in the time that I've been working with BlackRock, I've managed to travel all over the world to hear people tell me how they're using factors and what they want to do. A lot of it was happening in Europe early on. Norway is a place we see a lot of discussion around the pension fund there, how they were early using factors and understanding the sources of their active return. Asia has been growing tremendously, but Latin America is an area where we see exciting growth, I should say, in factor usage as well. One of the major used factors right now is the minimum volatility, which we'll talk a little bit more about later. So what strategies are most common? You again heard discussion a little bit today about multi-factor. If we say there are 5 or 6 factors, and we understand that each of them have periods where they might outperform and underperform, it makes sense to diversify. This is what people are doing, is blending the factors together and maybe using a little more of one at certain times to express a point of view. That's the most common theme, single multi-factor usage. You can also think about using signals to drive your decisions, right, through different kinds of economic regimes. How much is the factor worth? How expensive is it? How much dispersion is there in the market? What kind of market are we having today? Are we in a growth period or a contraction period? And how does that factor compare to others? So when we think about that cyclicality, let's get into a little more detail, right? I think we talk to a lot of people in our meetings who are familiar with sectors. And they would say, well, when I feel the market is strong and growing, I like sectors like consumer stocks. I like industrial stocks. When I feel the market is contraction, I might like utilities or consumer staples or telecom companies, more stable firms that maybe don't move around as much with their equity pricing. But in any case, when you think about factors too the same way, first we talk about how the factors work. There's really 2 main reasons why factors can have a long-term risk or return advantage. Some of these are behavioral, right? People tend to look at a momentum stock and want to buy it more, some of those who may not own it, which increases the price even further. With low volatility portfolios, there are many investors who want higher risk assets, so they don't spend as much of their capital on low risk ones, which leaves those kinds of assets underpriced. You would divide these into 2 kinds of reasons, the behavioral and structural reasons these factors work. You value firms too. Value companies might be more old-fashioned. They might have more debt on their balance sheet, making them less nimble, less able to change with the economy. And of course, if you're going to invest in that kind of firm, you would want some kind of additional return for that risk. And small cap is the same way. Small cap firms may have a harder time getting funding when they need it, and therefore demand a higher risk premium. So when you think about what people do with smart beta, again, it's really one of 2 things or the combination. It's about lowering their risk or increasing their return, or both. Each factor has its own characteristic. When you blend them together, one of the things we hear a lot in some meetings is this seems complicated. This seems like it would have to change our investment allocation process. And I hope more and more people understand the answer is that you don't. You don't have to change that. You think about passive equities, wherever they may be, more and more use of factors is replacing some of that to extract a little more risk-adjusted return from those types of assets. So again, looking at the business cycle, this curve represents in a very clean way how the market environment might work in, let's say, the United States, or any market really. And you see some of the factors that perform best in a rising market should be size and value and momentum. And then in a declining market, momentum and quality, more defensive. How does it work in real life? Well, we can go through some examples here. This is from different calendar years. So what you see on the screen is the value index over different years. It's 2001 all the way up to 2015. Now, the important thing to see is that, let's use the mic here. The important thing to see is that at the very end, value has outperformance over that whole period of 3% per year. But in any individual year, you might not be able to predict exactly when it will outperform. You can make some reasonable assumptions. 2008 was a year when it did better. 2010, not so much, but it can be hard to predict. If you do the same thing with momentum, again, it's hard to predict year over year what exactly will happen. And of course, these are all the factors together, right? You start to see some patterns here. In 2008, the financial crisis, the defensive factors did better. Minimum volatility, momentum helps protect on the downside. But you start blending these factors together. This is showing you the blend of 4 of these factors together. And what you observe is there are less periods where they are below the market return. The black line is the market return. and only 4 times below. Another way to look at that is on a rolling one-year basis. So now we're putting some real data behind these concepts of multi-factor investing. And you can see each of these individual factors have periods where they are above and below the market. They're cyclical. But when you combine them, you get this solid blue, which is sometimes below, but not as often. And in fact, we found that with US equities, a multi-factor blend is outperforming 77% of the time. So not all of the time, but it's enough to be meaningful and to start to attract interest. Now this is looking at economic cycle with real data, right? Looking at US economic cycle and different factors. This is a slowdown period, contraction, recovery. An example over here, you would see quality outperforming on the downside, right? What is quality? Quality is really investing in firms that have less debt, higher return on equity, and stability in their earnings growth. You can think about Warren Buffett. What Warren Buffett does is quality investing combined with value. He likes to buy securities that are inexpensive, but also not just cheap because they're bad companies, right? Good firms that will last a long time that are underpriced. So one of the biggest questions we get is, has the opportunity passed? And even today, I was on the phone with someone who said, well, all these stocks are going to get expensive. Everyone is buying factors. So the effect will go away, won't it? Won't it just become the market? And I understand that, I get that, but the data doesn't really support it when you really break this down. This is something, again, we hear in the press a lot, that everyone is putting their capital into low volatility or low beta portfolios. These have caught the most attention. So we really wanted to examine this and figure out if we could find the answer. Is it true? And before I even show the data, the first thing I say to someone like that is, well, you know, the investing world has had 80 years to figure this out, and they kind of haven't figured it out yet, right? None of these strategies have become so popular that everyone is in them, because everyone has different risk tolerance. But then you start to look at the numbers as well. And I know this is too much small print for you to see, but it really goes back to what Craig from S&P was showing you when you talk about the size of the market, right? We just see and focus on US equities, where there are the most factors available. There's $20 trillion of market cap in the US. And of that, it's less than 5 basis points in minimum volatility funds, which have attracted the most assets in ETFs this year. So you can say to someone, okay, that's quite small. But then their response is, what about other strategies? What about active funds that follow low-risk investing? What do those add to the mix? And we still see that when we put it all together, the average stock ownership among all active funds is about 15% of the market. Not very much. And the average stock ownership across minimum volatility ETFs is about 10 basis points. So this data is available. People can see that, you know, factors are not driving the whole investment world, not any single one of them. Finally, we took all that data. When we showed earlier how you can look at an individual fund through a risk model and see how that fund is getting its return, you see which factors that manager is choosing. So we wanted to test, if you look at all of the funds in the market in the United States and put them all together, which factors are these active managers choosing? And we found that most of them are choosing higher risk, more momentum-like strategies than minimum volatility. And in fact, it's so much more that you could add another $600 billion into low volatility strategies before you match the same amount of assets in high risk strategies. So it's a big difference. So it's always important to look beneath the surface when thinking about factor investing. And that leaves me with the final piece. And I know I'm ending a little early because, again, some of my material was covered for you by the previous speakers, but this one is important. When we think about smart beta, when you think about factors, you know, we suggest not being fooled by anything that seems new and just promises higher return. It's important to ask important questions before implementing a factor. And really there are four major ones. One is that factor should have some economic rationale around why it works. Can you explain to someone why a value stock should outperform over time? Can you explain to someone why a momentum stock should outperform? There's plenty of research behind these factors that work, which makes sense when you think about the broader economic environment. Number two, there should be some value creation, right? There should be some performance advantage that is shown over different types of markets in different cycles. Maybe not all of the time, but more than half the time there should be some advantage. Otherwise, it's not worth pursuing. Third, there should be diversification. When we talked about single factors, you saw they were cyclical. Sometimes they outperform, sometimes they underperform. But putting them together is just like putting together any kind of assets that are less correlated. You achieve a diversification benefit. This is what we're seeing today, is most of the investors we've surveyed around the world are putting factors together as part of their asset allocation and achieving a diversification benefit. And finally, it should be able to be implemented efficiently. That means the strategy should use assets that are liquid, that are available, right? For instance, some active managers might get return from buying a stock that is very small, that isn't very liquid. That kind of approach couldn't really be put into a smart beta strategy very easily. So following that kind of thinking, you can really put your due diligence process forward, thinking about factor investing. There's a lot of data today. There's a reason all of the panelists were talking about this too. I think the first revolution came with indexing versus active management. That raised the bar a little bit, and now the bar is even further up with smart beta investing. There's plenty of questions to come, and we're happy to have that discussion, as is anyone else I'm sure you saw today. And with that, I'll end there and say thank you, everyone, for staying, and enjoy the time in Cartagena.